Welcome to Talk Tickers, where we cut straight to the core of the market-moving earnings calls.
And today we're doing a deep dive into Standex International Corporation, that's SXI. We're looking at their fiscal first quarter 2026 results, which they dropped pre-market back on October 31st.
Right. And our mission here is really to look at the momentum behind SXI's, well, it's a pretty big strategic pivot they're doing.
It really is. They're moving away from being this sort of diversified industrial company.
Yeah, lots of different things.
Towards a much more focused, high-growth electronics platform. And it's all centered on electrification globally.
So we want to measure how that pivot's actually going. And critically, what's the cost? What's the short-term friction involved in making such a big change?
It's a really interesting quarter because, honestly, if you just looked at the operational side, SXI, they knocked it out of the park. A very, very clean operational beat.
Okay, let's put some numbers on that. Revenue came in at $217.4 million.
Which, yeah, beat the $216 million consensus pretty comfortably. And that's, what, 27.6% year-over-year growth?
Massive.
Huge growth. And then adjusted EPS, $1.99. That was, well, quite a bit higher than the street's range of $1.90 and $1.94.
And you saw that strength in the margins, too. The adjusted operating margin, it expanded 210 basis points year-over-year, hit 19.1%.
210 basis points. So that's 2.1% expansion. That's really material.
Absolutely. Great execution.
Fantastic execution.
And
here's the kind of paradox we need to unpack right away. Despite all those great adjusted numbers, the market seemed, well, unimpressed, is putting it mildly.
Exactly. The stock closed the day down 2.3%. And look at the volume way up, like 275,000 shares traded versus their average of about 120,000.
So double the volume, stock down, what gives?
Well, it's just profit-taking, maybe some valuation concerns, but fundamentally, the adjusted numbers hit some pretty significant friction points. Their GAAP EPS, the actual bottom line profit. That was way lower, $1.25. Okay. So investors saw the beat, but then maybe they looked deeper and saw the underlying costs. What was dragging down that GAAP number specifically?
Yeah, it seems like it. It was almost entirely stuff not related to the core operations, really. More about the debt and the cost of making these changes.
Okay.
The two big things were significant interest expense, about $8.9 million just for the quarter.
Wow.
And then roughly $6 million in restructuring charges. That's tied to this big optimization plan they're running right now.
Okay, so that creates this perfect narrative tension, doesn't it? You've got management saying, look, we're executing, we're delivering huge growth in electrification, but the market's immediate reaction is, nope, taking profits.
Precisely.
Is the market right to be worried about that interest expense? I mean, almost $9 million a quarter, that's a recurring hit tied to their debt, right?
It's definitely a valid concern, especially, in the current rate environment. It absolutely clips the quality of the earnings in the near term, no doubt. But I think the market's reaction kind of suggests they're maybe still viewing SXI as just another diversified industrial with high debt.
When management's trying to paint a very different picture.
Exactly. They're actively trying to position SXI as this high-growth, almost pure-play electrification story. So yeah, the profit-taking makes sense if you only look at the GAAP number hit, but it feels like it might be overlooking the strategic pivot that's actually delivering these record results underneath.
Okay, so let's pivot back to those record results then. Where is the growth actually coming from? What's the engine here?
Well, the momentum is just, it's undeniable right now. Management reported record quarterly orders. Get this. Approximately $226 million in new orders came in.
$226 million in one quarter? Wow.
Yeah. That massive pipeline is exactly why they felt comfortable actually raising their full year 26 revenue growth guidance. They bumped it up by $10 million. Now they expect incremental sales growth of over $110 million for the whole year.
So this isn't just steady growth. It feels like it's accelerating.
It really does.
And the main engine, you mentioned electrification. Is it that new unit, the Electronics Grid business?
That's the absolute core of it. It's that key acquisition they integrated. The old Emran Orion business, now they call it Standex Electronics Grid.
Okay.
It delivered record sales, over $35 million just in Q1. And management sounds incredibly bullish. They're talking about regulatory tailwinds, grid modernization, green energy integration.
All the big trends.
All the big trends. And because of that, they now expect that grid business alone to grow by more than 20% for the entire fiscal year, 26.
20% growth for a core unit like that is huge. And it sounds like the whole electronics segment is doing well.
It is, yeah. The overall segment had a really healthy book-to-bill ratio of 1.06.
So bringing in more orders than they're shipping out. Good sign for future demand.
Yeah, exactly. And organic bookings in electronics were up about 8% year over year. So even outside the grid stuff, you're seeing strength in areas like defense, test, and measurement.
And I saw they're also really zoning in on specific high-speed areas. They call them fast growth markets, right?
Yeah, that's their term for the premium high-demand spots. The electric grid, data centers, space, and defense.
Okay, so really focused.
Very focused. And these markets made up a big chunk of sales in Q1, 30% actually, about $62 million. But here's the projection. SXI now thinks these fast growth markets will top $270 million in revenue for the full fiscal year 26.
Whoa, wait. From $62 million in a quarter, $270 million for the year. That implies something like, what, over 45% year-over-year growth in just that specialized portfolio.
Massive growth. And it's not just scaling up old products. It's being driven by innovation, new products.
Which presumably have better margins.
Precisely. New product sales were up over 35% year-over-year in Q1 alone. And they're aiming to launch more than 15 new products this fiscal year. And crucially, management made a point of saying these new products are specifically targeting above core margins.
Ah, okay. So that's the why behind the pivot.
That's the strategic logic.
Yeah.
These new businesses are fundamentally more profitable, more defensible than the old mixed bag of industrial stuff. This is how they see a path to getting operating margins consistently above that 19.1% level they just hit.
That makes sense. Connecting the revenue growth to better quality earnings down the line, that's what smart investors look for. But let's talk about the messy part, the hard work, because this growth isn't free, right? What specific actions are driving those restructuring charges that hit the GAAP number?
It's mainly about streamlining their physical footprint, getting facilities closer to where these high-growth markets actually are. They detailed closing 4 manufacturing sites around the world.
4 sites? Where were they?
One in the UK, one in the US, one in Italy, and one in China. And yeah, closing those down generated about $6 million in restructuring charges in Q1.
Okay, now I got to push back a bit here. Closing 4 factories sounds hugely disruptive, costs money up front, messes with supply chains, hits near-term earnings. Management says this will generate about $5 million in annualized savings, but starting only in the second half of FY26.
Right.
Is that really enough payback? Does $5 million in savings starting maybe 9 months later justify the immediate $6 million hit and all the disruption? Does it move the needle enough?
That's absolutely the right question if you only look at it through the cost savings lens. But the savings are really only half the story.
Okay, what's the other half?
The other half is capacity expansion. They're closing older, maybe less relevant sites to basically fund building new strategically located capacity. And the scale of new capacity seems way tilted towards the positive.
Okay, tell us about that. What are they building? Where?
They're kicking off operations in 2 really key areas, Croatia and Mexico. Mexico is mainly to support North American demand, which makes sense.
Right.
But the Croatia plant sounds particularly interesting. It's positioned right there to support that booming European grid demand we talked about, plus data center power needs over there. And management actually put a number on it. They estimate that Croatia facility, just that one plant, could reach something like $60 million in annual sales capacity within just 3 to 5 years.
Wow. Okay, hold on. A one-time hit of $6 million in restructuring to potentially unlock $60 million in sustained high-margin revenue capacity from just one new site.
Exactly.
Okay, that completely reframes it, doesn't it?
Yeah.
That makes the restructuring pain look less like a problem and more like, I don't know, a really smart investment with huge potential leverage.
It really does. It shifts the narrative from just cost-cutting to strategic expansion and investment. They're clearly prioritizing grabbing market share in these fast-growing areas over, maximizing every single margin point today.
And you see that priority reflected in their Q2 outlook too, right? They guided for significantly higher revenue, which is great, but they flagged the margin side, saying expect only similar adjusted operating margin to Q1. Why flat margins if revenue is jumping up?
Yeah, that's a good catch. It's mainly down to a couple of things they mentioned. First, they expect a slightly less favorable product mix in Q2 compared to Q1.
Okay, mix shift. Happens all the time.
Right. But second, and probably more importantly, they're absorbing the upfront costs of ramping up those big new sites in Croatia and Mexico. Staffing, training, getting the lines running smoothly. That always creates a bit of a margin drag initially before they hit full efficiency.
Makes sense. It costs money to start up big new factories. Before we move on to the balance sheet, I wanted to quickly touch on how management is trying to simplify things. They've got new terminology for the electronics segments. I think it helps map what they do to the real world. Can you walk us through grid, edge, and detect?
Absolutely. Yeah, it does help clarify things. Think of it as mapping their different solutions across the whole electrical ecosystem.
Okay.
So grid, that's their high power stuff. Deals with the low and medium voltage transformers. This is the hardware that handles the actual, transmission and conversion of power for utilities, big infrastructure projects.
Got it. The big metal boxes you see outside.
Pretty much, yeah.
Yeah.
Then you've got Edge. Edge is their magnetics business. It's focused on power conversion components.
Okay, so what does that mean practically?
Think of these as the really specialized bits inside equipment. They take the massive power coming maybe off the grid or from another source and convert it into the precise, stable voltage needed to run, say, a huge bank of servers in a data center or sensitive defense electronics.
Oh, okay. Specialized power conditioners, kind of.
Precisely. And then finally, there's Detect. This covers their switches and sensors. These are critical little components used mostly for proximity sensing or level sensing.
Like what?
Or measuring fluid levels in industrial tanks or determining the exact position of a part in their aircraft landing gear or something. So yeah, Grid, Edge, Detect It helps you see exactly which part of the electrification world they're playing in.
That clarity is helpful. Okay, so let's connect this back to the big picture. How is the company's financial health looking as they're navigating this big transformation and building all this new capacity? Can they afford it?
Well, the balance sheet is definitely improving, which is critical, especially given the debt they took on for some acquisitions. They actually managed to pay down about $8 million in debt just in Q1.
That's good.
Yeah. And their net leverage ratio, that's debt relative to earnings, basically now stands at a much healthier 2.4 times EBITDA. And management said they expect that ratio to keep declining through the rest of fiscal 26.
And why is that so important?
Because reducing that leverage gives them more firepower, more flexibility for future targeted acquisitions. And they've strongly hinted that they're still looking for deals to further optimize the portfolio towards these high growth areas.
Gotcha. Okay, just a quick check. What about the other parts of the business, the stuff that isn't electronics? How did they do?
Yeah, the diversification still provides some stability, which is good.
Yeah.
Engineering technologies actually had strong organic growth, 12.7%. That was driven by good demand in space, defense, and aviation, all pretty solid markets.
Okay.
And engraving also showed signs of stabilization. It had 5.6% organic growth, and they specifically called out better demand in Europe, which is encouraging for that business.
So that leaves scientific. How did that do?
Scientific was the weak spot this quarter. It saw an 8.7% organic decline. Management mostly put that down to lower demand from academic institutions. Apparently, they've been hit by some specific NIH funding cuts in the U.S.
Right. So that just highlights how segments tied to government funding cycles can still be, a bit choppy sometimes. So, okay, we kind of circle back to where we started, this core market puzzle. SXI delivers beats, they raise guidance, they've got record orders driven by this really hot electrification segment. And yet, the stock sells off on the news. The tension is it's right there.
It really is. And I think it boils down to the market focusing intensely on that near-term friction we talked about, the stuff hitting the quality of earnings right now.
The interest expense, the restructuring cost.
Exactly. Investors saw the higher interest expense hitting the GAAP bottom line, and they saw the mention of near-term margin pressure from those really essential growth investments, like starting up the Croatia plant. And the stock had a strong run leading up to this. It was up over 25% in the past year.
True.
So for many, seeing that gap hit and the cautious Q2 margin comment was probably just a reasonable trigger to say, okay, time to take some profits. They seem to be prioritizing certainty today over believing the narrative about future growth leverage tomorrow.
Okay. And before we get to our final segment, we absolutely must emphasize everything we discuss here is purely for discussion and educational purposes. We're reviewing source material provided by you, the listener. This is not investment advice.
Yes. Explicit disclaimer time. We are not offering personalized investment advice. Any trade idea we bat around is purely speculative, just for illustration. Please do your own thorough research and due diligence.
Absolutely. But with that massive disclaimer firmly in place, if we were pitching an idea based on this data to some, imaginary high conviction investment committee, what's the outrageous but maybe plausible thesis here?
Okay, the outrageous but plausible idea is this. The market's negative reaction right now, which seems triggered mostly by this temporary gap noise and ramp-up costs, actually presents a short-term entry point. It's for a conviction long position.
A long position. Okay, and the thesis hinges on what exactly?
It hinges entirely on the timing of when things accelerate on the P&L, the profit and loss statement.
Okay, walk us through how that acceleration might set up.
Well, we know the immediate pain points, right? The $6 million restructuring charge, the initial costs of ramping up Croatia and Mexico, those are heavily front-loaded in the first half of fiscal 26.
Right, hitting now and Q2.
Exactly. But we also know two potentially positive things are scheduled to hit the P&L in the second half of the fiscal year. First, that $5 million in annualized cost savings from closing the old sites finally starts dropping through to the bottom line.
Okay, savings kick in.
Second, the revenue from those 15-plus new high-margin products they're launching should really start to accelerate and contribute meaningfully.
Ah, so you buy now, essentially betting that the combination of those restructuring savings finally showing up, plus the revenue from higher margin new products, will more than overcome the initial investment costs.
That's the core bet. You're betting that this synergy creates a visible, maybe even undeniable, earnings acceleration in the back half of fiscal 26.
And that acceleration would then presumably catch the market's attention and maybe re-rate the stock.
That's the setup. It's fundamentally a bet on management continuing to execute this grid and electrification pivot really well. Maybe targeting a return towards or even past those like $260 price targets some analysts have reiterated recently. The idea is the market is mistaking necessary, temporary friction for some kind of deeper systemic problem in what's actually a multi-year growth story.
Okay, so to recap our deep dive today, SXI delivered, operationally speaking, a very solid quarter. Clear beats on adjusted metrics driven by record orders, impressive strength in their newly focused electronics grid business, and that led them to confidently raise their sales outlook for the full fiscal year 26.
Yeah, the operational story looks strong. But the central question, really, for you, the listener, to mull over is this. SXI is making these big multi-million-dollar bets today. Investments in global capacity in Croatia and Mexico. Investments in launching these high-margin new products. The question is, will these investments translate into sustained, meaningful operating leverage? Not just later in fiscal 26, but more profoundly into fiscal year 2027.
Right. Will it make the current restructuring friction look like just a temporary speed bump on their road to hitting those ambitious long-term targets they've set out for fiscal 2028?
That's the multi-million-dollar question, isn't it? That's the ultimate test of whether this industrial pivot truly pays off.
Indeed it is. Thank you for joining this deep dive into SXI's latest quarter. We will be back soon with more of the critical earnings analysis you need.